This week's number, 60,000 pounds. That's the cost of a new James Bond-inspired vacation called The Assignment, which includes training sessions with Daniel Craig's stunt double, poker games, and vodka martinis in locations across Europe. True story, I once starred in a James Bond-themed porn movie. I was nervous, but I managed to come on cue. That's good. All right. Welcome to Prof G Markets. Today, we're discussing First Citizens' acquisition of SVB, Hindenburg's short on Block, and Lululemon's latest earnings. Here with the news is Prof G media analyst and future porn star, Ed Elson. Ed, what is a good word? By the way, when I took Viagra, I felt like Roger Moore. Roger Moore, get it?
As in you were bigger, or what's going on there?
Just more. Just more. I was 18 again, which means I was a virgin. But anyways, go ahead.
Well, I actually have a better number for you.
Yeah.
My number is 46.
Go ahead.
That's where the Prof G pod ranks in all podcasts globally as of this week. That puts us one ahead of Megyn Kelly, 16 ahead of Logan Paul, and this is my favorite, more than 100 ahead of the All In podcast.
There you go.
What do you think of that, Scott?
Yeah, 46. But it's interesting, the ranking. I'm obsessed with the affirmation of others. I'm addicted to it. That's my addiction. And I think it's important that people understand their addiction. I'm being semi-serious. As much as I joke about alcohol and THC, I don't think I'm addicted to either of those substances. I am addicted to the affirmation of strangers, which is totally pathetic. But I go to this site called Chartable, which tracks Apple rankings. But what it clearly is it's new downloads or new registrations, because I think it's more based on momentum than actual downloads.
Don't give it
away.
So
because of the Bill Maher, because of the Bill Maher thing, we got a ton of new interest, new downloads, so it'll spike. But unfortunately, I think it'll come back down.
Well, we'll see next week. But by the way, something else interesting. We're ranked 46 in the world, 65 in the US. So it's the internationals who are sort of
global. We're global. I work in the macho nations. I work in South Africa. We over-index in South Africa and Brazil, and also what's our other one? Oh, Australia. We're big in Australia. Yeah.
By the way, I think your door's ringing.
It is ringing.
Who's that?
My
edibles delivery.
So my house is literally basically an Amazon distribution center, and there is so much shit that comes in and out of this house. It's just Amazon should just literally turn this place into a warehouse, and we'll keep 10% of everything they stock. But anyways, talk to me about today's news.
Let's do it. Let's start with our weekly review of market vitals. The S&P 500 gained, the dollar fell, Bitcoin briefly hit $29,000, and the yield on 10-year treasuries was relatively stable. Shifting to the headlines. For the first time since Russia's invasion of Ukraine, gold rose above $2,000 per ounce. That was triggered by the global banking drama. AMC's stock soared 21% after a report from The Intersect said Amazon is considering purchasing the theater chain. Alibaba shares popped 14% after it announced plans to split its $220 billion conglomerate into 6 distinct business units through separate IPOs. Elon Musk, along with 1,000 other tech leaders and researchers, signed a letter calling for a 6-month moratorium on any further training of advanced AI models. They said that AI poses, quote, profound risks to society and humanity. Federal prosecutors charged FTX founder Sam Bankman-Fried with foreign bribery. SBF allegedly paid Chinese officials $40 million to unfreeze accounts linked to his other company, Alameda Research. He now has 13 criminal counts pending against him. And finally, the Commodity Futures Trading Commission is suing Binance and its CEO Changpeng Zhao for, quote, willful evasion of regulations, calling its exchange illegal and its compliance program a sham. Scott, what are your thoughts here?
So gold is a flight to safety. Well, I've never understood how gold would be part of your go bag. It's just so heavy. I always thought that was the appeal of Bitcoin, is to get $1 million worth of Bitcoin across the Atlantic is pretty easy. That's a thumb drive. $1 million of gold at 2,000 bucks an ounce. That's 500 ounces. What is that? That's about 30 pounds. I mean, you're carrying a dumbbell.
Yeah.
Anyways, it goes up, it goes down. I don't think that's that interesting. AMC, I don't know if there was any news today. I think this was a leak from AMC. I just don't buy, and famous last words. I don't see why Amazon would buy this company. Or I can see the kind of the industrial logic that they'd want to go vertical, give their internal production studio a front-end distribution in theaters. But it's just such a shitty business in decline. I've never seen them invest in a business that's in structural decline, which is movie theaters. So I wonder if somebody at AMC leaked this story.
As in made it up, or?
I wouldn't be surprised if maybe, who knows, maybe Amazon looked at it at some point. But Amazon's so disciplined and so, they're so analytically driven. I would be interested to understand what I saw and predicted the acquisition of Whole Foods. That made logic to me. It was inexpensive. It's a profitable business. It was trading at a multiple, but that just made a lot of sense to me. And and it's a growing business because it caters to the top 10%. The movie business or the movie theater business is just a movie in structural decline. It's just not going to. It'll have little blips up, and a bunch of billionaire directors will claim it's a collective when they go to the movies once a year. So I just don't buy it. We'll see. Alibaba, this is a great idea, and this is actually kind of the most interesting business story of the week. Them splitting into 6 companies is trying to unlock the company from the conglomerate tax. And what do we mean by that? CEOs like to acquire different assets or launch different companies, taking advantage of the brand and their customer base. And oftentimes what they end up with is these corporate Frankensteins where there's really very little synergy. And the market hates conglomerates because what the market wants is a CEO and a company that are singularly focused such that they can understand the company, understand its metrics, and hold that CEO accountable. And the CEO likes to acquire stuff because their compensation goes up because the bigger the company, the bigger the range that their benefits or their compensation consultants will tell them the CEO should be paid for. And they always love the idea of a hit acquisition that makes the world much easier than actually building something. But 2/3 of acquisitions don't work out because people typically overpay. But you end up with these multi-headed hydras that kind of make no sense. So the disposition of assets when you're paying a conglomerate tax is accretive to shareholders. And an analyst did the work here at Alibaba, and then, and this is the important part in the second part of the story, got the blessing of the CCP. And it strikes me that the CCP is on a bit of a charm tour right now. And that is Jack Ma showed up and seemed friendly and didn't have any visible scars. And they didn't have, jumper cables attached to his nipples saying, say nice things about communism. That was a little graphic. Anyways, but basically it seems like Xi has figured out, okay, I wrapped the knuckles of these companies, cut some fingers off. Chinese internet economy has just been, smacked upside the head. And they've said, we've got to show some growth here. We got to let our thoroughbreds run. And I think you're going to see more of this. I think you're going to see even some photo ops with American internet companies and their great partnerships. But basically, I think the frost is thawing in the Chinese internet sector. And Alibaba's breakup into 6 disparate companies is a great move for Alibaba shareholders. And there's a larger story here, and that is around a thawing in the chill across the Chinese internet sector as the Communist Party there is about to become a wind at their back as opposed to a wind in their face. This whole AI thing, this letter, and I said this on Pivot, I take anything Tristan Harris says seriously. However, I wonder if Elon Musk, if he had wrested control of OpenAI, which he tried to do, and my understanding is was kicked out, I wonder if he was in control of it, if he'd be advocating for a slowdown. And I'm all down with the notion of a slowdown. I understand the threat that this thing is technology that could get out ahead of us, and it will obviously have some potential or could be potentially weaponized. The problem I have is unless China, Brazil, North Korea, Iran, and Russia are going to sign this same go slow pact around AI, I think it could backfire on us. And that is, we knew that developing the hydrogen bomb would probably be a bad idea for the world. But if we stopped unilaterally the development of hydrogen bombs or splitting the atom, we knew it would be really bad for us.
Yeah.
So my feeling is we should absolutely go full steam ahead, but we need regulatory bodies and then ideally some international cooperation to say, okay, this shit's scary. We should all agree to a certain level, certain protocols. What do you think? What's your take on this?
Well, my question is, what does that even mean? A 6-month moratorium on the most important technology of our age? Like,
how do you do that?
What is that going to mean? I mean, they said anything that's more advanced than GPT-4. Who's to say what's more advanced than GPT-4? And basically, the only company that's creating anything more advanced than GPT-4 is OpenAI. So, are we just saying, fuck OpenAI, we need them to slow down, they're scaring us? I mean, it's also just completely goes against all of Elon's sort of anti-regulation stance. I mean, he's constantly criticizing government for getting in the way and slowing things down. And suddenly he's decided that this issue is really scary and really important. And he's going to sign a letter with a few AI researchers and experts. And we're all just going to say, yeah, this company just is going to stop in its tracks. I just think I don't think it really makes any sense, to be honest. And there are a lot of smart people on that list. You know, Gary Marcus, who we had on the pod, who's really smart, educated guy on AI and an important voice in this sector. And he signed off on that letter. He's been talking about it. But I'm just like, you know, how are you going to do this thing? It doesn't actually make that much sense to me. And at a certain point, it's raising awareness for the dangers of AI, but is it going to actually get anything done? I doubt it.
This to me feels a little bit like a lot of people on this list feel like they should be more involved, and they're not.
Right.
And again, Elon Musk didn't seem to want to slow down when he rolled out autonomous driving to some disastrous effect. He doesn't seem to want to slow down in terms of, you know, Tesla is now getting safety recalls, but I'm cynical. I think if he had wrested control away from Sam Altman and had turned this into a for-profit that was going to turn him into the world's first trillionaire, he wouldn't be saying, I'm going to slow it down.
Yeah.
Feels like a desperate yelp for relevance in a group of people who probably have insight, probably have some well-founded concerns, but quite frankly are a little bit pissed off that they're not at the center of this. Mm-hmm. I'd like to see this should be a call for more thoughtful regulation, just as the government is developing Space Force down in Alabama to deal with the emerging, a new wing of the armed services dealing with conflict or defense or war in space. It seems like we need to assemble a group of really thoughtful people, including Tristan Harris and not Elon Musk, to talk about the future of AI, what regulations need to be put in place. But be clear, someone is going to jump out ahead of us on this issue if we don't. And then the last story on SBF. If there's any way to put someone in prison for like 11 lifetimes, they're going to try it with this guy. It just seems like his sentencing hearing is going to go for 10 weeks.
Yeah.
I just get the sense he is definitely going to pay for the sins of all of crypto. And then Binance. What I would ask you, and we said this 3 months ago with the implosion of FTX. What's to stop Binance from meeting the same fate as FTX whether or not there's fraud there? It seems like a lot of it is collateralized or financed based on their own coin.
Yep.
What do you think happens here?
Well, I think you got to look at the lawsuit itself, and there's no indication of fraud or a Ponzi scheme, though you never know with these crypto companies. What they're accusing them of is that they're letting U.S. customers trade crypto derivatives without registering with the CFTC. And that's it. Binance is not registered in the U.S. They're registered in the Cayman Islands. And basically what they've been doing is they've been trying to sort of under the table tell U.S. customers how to become a user with Binance. And it's not necessarily the retail customers that the CFTC is worried about. It's their big high-frequency trading firms that are that are Binance's, quote, VIP customers. And basically what Binance did is they said, you can't be a client unless you set up a VPN, which will shield your IP address and will allow you to be a user on our platform. And then it later came out that also Binance was illegally operating in China. They were doing the same thing. All of crypto transactions in China are banned, and they're just offering services to all these Chinese clients. They're even using a Chinese bank to pay employee salaries. So all of this is just a problem of you haven't registered in our nation, and that's a problem. But
sounds like Uber.
Exactly. Exactly the same. The thing that I find is different here is, as you mentioned, there's this comparison between Binance and FTX. I think back to last summer when there was the first big crypto winter wave, and you had Coinbase's revenue was down 60%. Celsius, that big crypto lender, they failed. So did BlockFi, so did Voyager. Everything was collapsing, and then amid the collapse, there was this one winner that was, for whatever reason, it was crushing it, and that was FTX. And FTX bailed out BlockFi, they bailed out Voyager, they were hosting conferences and hiring Tony Blair and Bill Clinton to come and speak about the future of crypto. And the question that we were asking was, what on earth is FTX doing right that everyone else is failing at? And was it maybe they're just really good traders, or they have a nice regulatory environment in the Bahamas? And we said this, they're probably just doing something really shady and illegal. Mm-hmm. And we should have said it earlier, and we should have said it more publicly, but we didn't have any evidence. And so the first thing, when FTX finally did collapse, the first thing I said is, I went to Twitter, I said, Binance is next. Because the thesis here is very simple. If your business is predicated on existing outside of the law, and generally that means existing outside of the US, which has probably the strongest regulatory environment in the world, if that's the first pillar of your business, and second, your sector is in structural decline, there's just no way that you can win this game. You're bound to fail. And I think that's the difference between Uber and Binance here. Uber was eventually able to get over that line of regulation because actually this was a company with a great use case and there was a market for it. There's no longer a market for these crypto derivatives. So I think, 12 months from now, Binance is probably not a company anymore.
Wow. There you go. I like it. So just a quick footnote on the letter written about slowing down AI. The co-founder of the Future of Life Institute is a guy who's a long-termist who believes that what matters most is for humans to fulfill their potential in the cosmos. Okay. How about fulfilling it right here in Brooklyn? And according to him, this includes colonizing the universe and ultimately living rich and happy lives within a computer simulation. So this guy has either done too many or not enough mushrooms, but I don't think that adds credibility.
What's the guy's name?
Jan Tallinn.
Jan Tallinn. Let's get him on the pod.
There you go.
Okay, let's move on to our first story. It's official. Silicon Valley Bank has finally found a buyer, First Citizens Bank. First Citizens is based in North Carolina, and it calls itself the nation's largest family-controlled bank. It'll get SVB's $72 billion loan portfolio at a roughly 20% discount. It'll take over all of SVB's remaining $56 billion in deposits, and it'll also get a $35 billion line of credit from the FDIC to cover potential future losses. However, the FDIC will retain the long-term treasuries that sparked SVB's decline. Shares in First Citizens surged more than 50% after the news. So, Scott, the first time we discussed SVB, you predicted that a bank would come in and take it over, and the depositors would be safe. That appears to have all happened. Did it go down in the way that you expected?
I thought it was going to be a big bank that would want entree into the venture world. This was two regional banks making one bigger regional bank. The learning here is that one of the things about investing is that, well, there's two things. First is, of all the asset classes or all of the different parts of the life cycle investing, there's seed, venture, growth, public growth, mature, value, and then distressed. I have found on a risk-adjusted basis, the best place to invest is distressed. And it comes down to one thing, that you really need to be careful not to trust your instincts. And occasionally you want to, when your instincts are really strong, you want to pause, try and put your emotion, your instincts aside and think the other way. Develop a thesis that zags while everyone else is zigging, because humans will do almost anything to avoid pain. And when we come off the weekend where shareholders lost all of their money in SVB, you think that must have hurt. I don't want to have that. I don't want to endure that kind of pain. And so the entire sector starts getting pummeled. And you immediately think, wow, I hate this sector. This whole sector is in trouble. It's probably my instincts are to short the sector or to sell my banking stocks. Mm-hmm. And that might be right. But at a minimum, you want to slow down and go, okay, instincts are rooted or cemented in us or implanted in our DNA over millions of years. And the way they get implanted is that they are the common emotion across the majority of the species. And that is, you are scared of fire, and so is the majority of your species. Yep. And when everyone's running, when your first instinct is, I need to run from all bank stocks, you need to recognize that that instinct is probably prevalent across the majority of investors right now. Now, what does that mean? It means everyone's a seller. And when everyone's a seller, it means that decent companies that'll survive this mess get unfairly punished. They're the babies that get thrown out with the bathwater. So First Citizens is an example of that. And that is, this is a company that is basically built on the backs of failed banks. They've done this 11 times. They go to a failed bank and they say to the FDIC, they say, Dad, will you pay for this? Will you put me in business and you absorb all of the downside because you're dad and you have more money than me, but I'll give you some of the upside. Mm-hmm. They've done this 11 times. And as evidenced by the terms here, basically, you know, they're saying, here, you take the shitty, dangerous, explosive assets that have long-term maturities on them. I'll take the other assets. And basically, you'll backstop me, finance the acquisition, and all I have to do is give you a portion of the upside. It's as if, say I finance you to buy a Chick-fil-A, and you didn't have to come out of pocket for it, and you became the manager and managed it, and you just had to give me a small percentage of the upside. It's just a great deal. And First Citizens has not only made great money over time, banks generally aren't that volatile. Upon the close of this deal, First Citizens shares went up 50%. That is enormous. So the lesson here is that when you see something on fire, everyone's instinct is to run. But as an investor, you want to immediately check your instincts and go, should I be running into the fire? There will be some regional banks here, some niche regional banks that have a great business, that have not experienced a run, that have not experienced large outflows, but their stock is off 30, 40, 50%. That's where the opportunity is. Your instincts and your emotions are your enemies around investing.
On another note, so we were talking about First Republic last week, and First Republic stock rose around 11% after the government said it would help any more struggling banks. It would provide further assistance. It feels like maybe, I mean, it's still way down compared to the beginning of the year, but it feels like maybe the contagion is subsiding. Has it?
That's what it feels like. It's just not on the news. I mean, CNBC feels like they're trying to keep it alive. I turned on CNBC for a moment this morning. You know, media loves to catastrophize because it keeps you glued to your TV screen or to your smartphone. But it doesn't feel. I haven't heard of any other banks going down. I mean, the kind of stress testing circled the globe. It forced Credit Suisse into the hands of UBS. But I haven't seen any kind of DEFCON 4 on any other regional banks. Just the notion that SVB, which is arguably the most hated bank in the world right now because it has the term Silicon Valley in it, the depositors there got backstopped 100 cents on the dollar. So I don't think depositors are that scared. Even with all the catastrophizing on CNBC, I think they say, well, if they bailed out those douchebags in the Valley, they're going to bail out us in Kansas if something goes wrong at First Kansas. Mm-hmm. So it feels like this is, in fact, calming down, that we're, I mean, quite frankly, the best thing that could happen to regional banks right now is some other catastrophe in the news. And unfortunately, there's so many mass shootings that we seem numb to that. I mean, that just kind of happens every day. And the shooting that just took place in Tennessee, that diverts our attention for what is a tragically small amount of time because there's just so many of them. If that had happened here in the UK, and I'm going off script here, but there was a mass shooting in Dunblane, Scotland, and 16 kids and 2 adults were killed. Tragic. It happened in 1997. And immediately the citizens of the United Kingdom said, well, this is intolerable. We just can't have this. And so they passed several laws around the possession of firearms and handguns, the types of weapons you could own, the need for registration. And since 1997, in 26 years, there hasn't been a single school shooting in the United Kingdom. We've had 13 so far this year in the United States. So anyways, a bit of a digression, but this is when people throw up their arms in the United States and say that there's no way we can solve this problem with a problem that is uniquely American, that just makes no fucking sense. This is the most tragic thing about gun deaths in the United States, whether it's school shootings, whether it's suicides, is that we know exactly how to fix this. But because we have minority rule, because of the NRA, we have been overrun by money and by far-right Republicans who see votes in just having this sort of staunch anti-government absolutism, extremism around guns. But the majority of Americans want some form of gun control. And this is the most fixable, unnecessary cause of death, disease, and disability that has existed in the United States. It's really gross. Anyways, back to what we were talking about here. This thing will be officially kind of over once there's something else that occupies the business headlines. Because if there was going to be a run on these things, it probably happened last week, and it feels like all of them had the liquidity to withstand those withdrawals.
How do you think history is going to remember this? Because specifically from a political perspective, I was watching a Trump's interview with Sean Hannity, and Hannity asked him about this Silicon Valley Bank situation. It's already become a political issue. And Trump's response was, the government dealt with this terribly. It was so awful. I wouldn't have bailed them out. This was a big government bailout. I mean, sort of stuff that you would expect. Do you think people will buy that? One, I assume you just completely disagree, but how will people look back on this, say, at the debates next year?
Oh, look, Biden could save puppies, and Trump and DeSantis would find a reason. I mean, until recently, DeSantis was saying our support of Ukraine was a bad idea. And then when he realized that was a really stupid thing to say, he's trying to walk it back now. But Trump would have bailed this pink out in a moment. I mean, the moment his Treasury Secretary walked in and said, okay, you might be the president that inspires a banking crisis, he would have, he bailed out with, in all caps, the economy during the novel coronavirus. So I think almost any president with full information would have just said, okay, I can either risk a collapse in the banking system and the dollar and financial panic, or I can come in and spend whatever it is, $24 billion to bail these guys out. I don't think this is going to be much of I think this will be a trivia question.
Yeah.
I think, we've argued before, or we've said before, I think Senator Warren, when she says banking should be a boring business, be careful what you ask for, because then it might become a boring business and the economy becomes boring. You want a limited number of ring-fence bank failures, because you want sort of some leverage in the system. Otherwise, we could do away with defaults on mortgage bonds by just demanding 80% equity for any loan. We'll loan you 20%, not 80%. And then what happens? Housing prices crash, and young people such as yourself can never own a home. And that's how it is in a lot of nations. There isn't available credit. So a certain amount of leverage, a certain amount of bank failure that's ring-fenced, again, sign of a healthy economy. I think we look back on this more as just the color around it. There'll be a Netflix documentary, maybe an original scripted program starring Jared Leto or, I don't know, Anne Hathaway or somebody. We'll see. Who would be good? Who would play?
You'd be
Greg
good. It's
Becker?
a bold guy.
Greg's a
do it.
ball guy?
Yeah.
I like it. I like it.
Let's get Kelly O'Coin back.
Load up on bonds. Everything's fine. Don't panic. Don't panic. As he's sweating and popping Xanax.
And selling.
Yeah, and selling. On the other hand, hold on a second. It's my broker. Sell, bitch, sell. Yeah, I could absolutely be that guy. I'm going to Hawaii. He pieced out to Hawaii. That guy has I would argue he doesn't have great judgment. Anyways, I don't think this is what I'd call a historic financial event. I think it's a trivia question in a year.
Yeah. And I just want to end on this final point, which is, so this transaction will cost the FDIC $20 billion. All of that will be covered by the fees that the FDIC charged the banks. In other words, taxpayers haven't paid a penny on this. And it feels like no one's actually lost money. So I guess the conclusion would be this turned out completely fine. But famous last words, we'll see what happens to the rest of the banking sector.
But it's just an important point. The FDIC is a separate off-balance sheet insurance entity that charges fees to banks to cover bank runs like this. And now you could argue that every depositor is going to have to indirectly pay for this because the insurance that the bank is going to be charged for FDIC insurance is probably going to go up. But I think they have $120 billion in that reserve fund or in that insurance fund. They're asking the big banks to put in more. And I think their logic is the big banks are going to be the ones that benefit most from this because there'll be a flight of capital or a leaking of capital from small and regional banks to the big guys. The big guys will push back and say, well, why are we paying for the sins of these little banks? But the FDIC, think about this. This was the most expensive bank failure, I think, in history.
Yep.
And it took out, 18% of the insurance company's funds. And the reason why you have insurance is such that when there's a disaster, the insurance company comes in and makes everyone whole.
Yeah. Yeah, to me, this is a giant victory for the banking system. It's like we built this whole system in anticipation of this event. It happened, and then we fixed it. So I think it's a good way to conclude.
Good for us. Good for the banking system.
Okay, let's move on to our second story. A few weeks ago, we covered an Adani Group expose that was published by the US short seller Hindenburg Research. Well, last week, Hindenburg found itself a new target, Block. Specifically, Block's payments platform, Cash App. According to Hindenburg, Cash App is a fraudulent business. The report accused Cash App of faking its user numbers with duplicate accounts, taking advantage of people with, quote, predatory loans and fees, and it also alleged that Cash App is commonly used for illegal activity. As an example, it cited how hip-hop artists frequently rap about it in reference to drugs and murder. Block shares fell as much as 22% after that report was released. What are your thoughts on this, Scott?
Actually, Ed, I thought you had the most interesting take on this. What are your thoughts?
Well, basically, I don't buy it. Hindenburg, I really respected for a long time. I think that they've done some amazing work with the Adani Group. They did amazing work on Nikola. But this, to me, is, in your words, a giant nothing burger. They're reporting... let's go through the evidence that they actually said. So, one, they said that the user accounts are fake or they are duplicates. Their evidence for that is that some employees told them that. And I just don't really think that you can trust former employees who maybe were laid off, who have some reason to dislike Block as a company. Either way, that's one thing that they thought. Second, users are engaging in fraud. Lots of people engage in fraud. I don't really understand how that's Cash App's responsibility to prevent fraud. I think that's the law's responsibility. And then third, the thing that they hung their hat on is that rappers use Cash App in their lyrics. And that, to me, is the giant tell that this is actually not that big of a deal. And the thing that I was thinking about from a personal perspective, they said at the very top of the report, we've been investigating Block for 2 years, which I assume was their way of saying, we've done our research here. From my experience, when I've been writing research papers or doing research for you, and I have a thesis that I want to prove, and I spend too much time trying to prove that thesis, there's a certain point at which I will refuse to accept that my thesis wasn't true. And to me, that's what's probably happened here. They've invested too much in making sure that they can bring this company down. They've invested money. They've shorted the company. They've also invested 2 years of their time and effort and their resources. To me, this is actually hurts the credibility of Hindenburg as a serious short seller and investigative firm.
Yeah, I think you're right. I think the temptation when you've been as successful as Hindenburg to keep doing what you do. My guess is they have absolutely no problem raising money, even for, not even captive capital. But if they call anyone right now and say, we have another idea, we're not going to tell you the idea, but we need $1 billion, they're going to raise that money overnight. So this feels like a bridge too far. This feels like, for lack of a better term, that they're reaching. Mm-hmm. And rappers talking about Cash App, I not only don't see that as a negative, it's a positive. It means it's part of the zeitgeist. The fake account stuff, I thought that was a problem. And then as you read further down in the report, the Hindenburg report, they say, as of now, that loophole has been closed. So I agree with you. I feel like this was a bridge too far. I feel like this is Bill Ackman's Herbalife. It won't play out as painfully for Hindenburg as Herbalife did for Ackman.
Take us through what happened with Ackman and Herbalife.
Bill Ackman put on a big short position in Herbalife, which is sort of a pyramid sales, household products, nutrition company where it's sort of like pyramid or they call it multi-level selling. And I think Bill Ackman, I think it offended his sensibility. I think as a guy who flies around on a Gulfstream and probably has an amazing home in the Hamptons, he probably finds that type of selling is predatory and can't relate to it. And I'm sort of the same way. I would never, I wouldn't want anyone I know involved in that type of multi-level marketing, whatever you call it.
Yep.
Yeah, because it does feel like a little bit like a pyramid scheme. But he took a huge short position, and he said things like the arrests are coming, which was probably irresponsible. I don't think anyone there had broken any laws. And because, as activists do, they all hate each other because they all want to be the biggest swinging dick at the Ira Song conference or, have the biggest home in the Hamptons. Carl Icahn weighed in and went long Herbalife and said, you're full of shit. Maybe it's not your Neiman Marcus or Lululemon shopping day, but this is how a lot of middle America makes money and buys stuff. He went long, and ultimately he was right. This feels a little bit like it won't be as painful for Hindenburg, but I don't think anything they've said about Block would connote the kind of like smoking gun that they found at Nikola, much less Adani Group.
Yeah. I mean, they point out things with the business that are just, standard. This probably isn't a great business. For example, it's overvalued. It's like, trading 13 times book value. Meanwhile, PayPal's at 10, and then all these smaller fintech companies like Robinhood and Affirm, they're trading closer to 2. So that's fair. They pointed out that, they're increasingly relying on non-GAAP adjustments. So their GAAP loss, and that's basically their standard accounting loss, was $541 million. And then after the adjustment, that they had a non-GAAP profit of $613 million. So like that's fair, but so are all these other companies. And then to sort of open this big report with, look at all these rappers who are talking about Cash App in reference to murder, it just seems like a giant exaggeration of what is likely just kind of an overvalued business. So the question that I would pose to you is, when someone like Hindenburg does this, or Ackman makes these claims about Herbalife, and they really go out on a limb to bring that company down, do you think that there should be any level of legal recourse if, in fact, Block can prove that what they said isn't a problem? I mean, I don't even know what there is to prove. It's like, yeah, these rappers did say Cash App in the music video. But what do you think about just the legal ramifications if you want to go gung-ho on a short position?
My understanding is, as long as you believe what you're saying and as long as you have evidence to back it up, you can exaggerate, you just can't lie. And a lot of it is in the phrasing and the nomenclature. that is it fraud or is it misleading or is it false advertising? Is it sex trafficking? Or what is it? So Block responded exactly as they should have done with one small tweak, and that is they responded with data. They went line item by line item across every accusation and backed it up with data and said, okay, you're right. When you applied for a credit card under the name Donald Trump, you could get it. That loophole has been closed. You're right. Rappers reference our currency or our payment method as they reference other currencies and payment methods. Have you ever heard the term Benjamin in a rap song? I think you have. So they refuted it with data. The only thing I wouldn't have done was they said they were investigating their legal options. I think that makes them look defensive. This is free speech. Your only legal recourse is when a company knows they're lying and spreads those lies, and those lies have direct, provable economic harm, such as what we're seeing with the Dominion case against News Corp. I don't think they're going to find that here. I think the stock recovers and everybody just moves on.
Just final follow-up. Don't you think that, Hindenburg, even if we are right, which is this company's fine, Hindenburg's still going to profit off of this because the terms of a short position only apply for a limited period of time. So they probably shorted with those options set to expire, like this week. Every time that Hindenburg has shorted a company, the company's value has gone down by an average of 15%. Like, this is a winning game, irrespective of whether they're right or not. How do you reconcile that?
Well, there's two things. The first is we don't know what the date was, how those options were dated. So if they massively went short the stock, it depends how long they hold it. Yeah. They might have thought this thing's going to get cut in half. And if they bought options, we don't know, or if they bought puts, we don't know if those puts were dated this week or in a month from now.
Yeah.
So we don't know how much money. If they knew they would be able to hammer the stock for a week, but then it would recover, they could adjust to that in terms of the types of options and the durations on them. We don't know what they bought.
Yep.
The second thing is every time you do a head fake, and activists usually coming into a company, I know as an activist investor, will move the stock in the short run. And you think, oh, it's a great strategy. Just go in, pop the stock. The reason you get that pop as an activist is you're seen as someone who's in it to win it. You're just not in there for the pop and then you bail.
Yep.
Because their ability to move stocks is based on the fact that, one, they've been right, and two, they're seen as long-term players that stick with their short positions and don't just kind of pump and dump or don't send a false flag, scream fire, and then run out of the building. So they can only do this so many times before that premium, that Hindenburg premium or implosion, if you will, begins to diminish.
Yeah. Let's go to our third story. Athleisure brand Lululemon reported fourth quarter earnings, and it was a big-time beat. Earnings came in at $4.40 per share versus $4.26 expected. Revenue rose 30% year over year to $2.8 billion. And the company issued guidance of $9.4 billion in 2023 revenue. That's compared to Wall Street's estimates of $9.1 billion. Lululemon shares popped 14% on the news. So, Scott, this seems like a good entry point into a discussion of high-end retail more generally. On the whole, the sector's been doing really well. Nike recently reported 20% annual revenue growth. So did Hermès and LVMH. We saw record revenues at Williams-Sonoma and Ulta. This feels like a really big year for retail. But the headlines don't really seem to match. So, weren't consumers supposed to be cutting back on spending?
Yeah, has anyone heard from the recession? You're not seeing it in retail. You're not seeing it, especially retail. I think some people would argue that the top decile of income-earning households, which my guess is make up a disproportionate amount of Lululemon's business, are doing really well. I don't know if that's true of Nike. I think Nike, their consumers across the range of income levels. I know that I think 2/3 of Nike's business domestically is actually people under the age of 30, and that 2/3 of the U.S. business is from people under the age of 30, but 2/3 of their total business is from consumers outside of the U.S. So Nike is a little bit of a global indicator It's a global indicator on youth. And I guess that it seems like globally, the top quartile, if you will, globally, young people are still spending money on shoes. So it was a great quarter. But again, it's further evidence that for the last 18 months, we've been a month away from a recession, and it keeps getting pushed back. So, but we're not seeing evidence of this in specialty retail. Restoration Hardware did report, a fairly mediocre quarter, but that's more kind of unique to housing and what's going on there. People aren't moving because they're either trapped with a low mortgage rate or they don't want to buy a new house because of high mortgage rates. But specialty retail, it would be difficult to find evidence of a recession. Again, if you didn't know we're supposed to be going into a recession, would you know we're supposed to be going into a recession? So this is just more evidence of that. The consumers are still spending. So in Lululemon, which is an incredibly well-run company, they have beat sales projections in 55 of its last 63 reporting periods. So that's just incredible. And year to date, their stock's up 13% after declining 20% in 2022. Nike's up 3%, the S&P's up 5%. And Lululemon, because of their reputation for consistently beating projections, trades at a 20 times EV to EBITDA multiple. And their historic multiple has been 32. So some people might even argue it's a buy right here. Nike isn't as discounted. It's trading at a 30 times enterprise value to EBITDA. It's considered one of the best brands in the world. But still, it trades at a higher EBITDA than Lululemon. And speaking of the swoosh, their Q1 revenue increased 19% year on year. And for a company this size, that's nothing short of remarkable. And back in June of 2022, after an earnings report, we said that Nike's fundamentals were really strong and that the factors weighing down the stock, specifically supply chain, currency headwinds, and a closed Chinese market, would subside. The other kind of quick stat we didn't talk about, and this just blows my mind, is that the market capitalization of Hermès is now 192 billion versus Nike at 187 billion. So Hermès, the scarf company, and it does more than that, but they're famous for their scarves, is now worth more than Nike. Hermès trades at 16 times sales, Nike at 4 times. And basically, this has been the world's best bet, has been a bet on income inequality globally. Hermès, their 5-year total return is up 287%. Basically, it's quadrupled in the last 5 years versus the CAC 40. It's just up 5%. It's just striking. And Hermès is such an incredible lesson in scarcity. And essentially, our species is drawn to whatever is scarce because the things that were scarce were the things that could keep us alive. Food, especially sugary or fatty food, or mating opportunities were scarce. So we are obsessed with food. We're obsessed with sex. And if any of us are ever in a position where our survival is threatened, we become quickly obsessed with survival. So scarcity is sort of the ultimate marketing strategy. And you can create it artificially. So if you want to buy a Birkin bag, you can go into a store and point at one, and they're going to tell you there's a 2-year waiting list, and kind of in a very pedantic way, kind of raise their nose and say, not everyone gets to own a Birkin bag. And there is no super crazy AI-driven semiconductor rare earth material that goes into a Birkin bag. They could make a lot of these, but they purposely constrict supply such that they create the illusion of scarcity, not unlike what U.S. elite universities do by sitting on these multi-billion-dollar endowments and not using them to expand their freshman seats because they become essentially the Birkin bag of a modern society, where the ultimate luxury item for a Chinese parent or a Dutch parent is to send their kids to an elite American university. And as a result, we can charge kind of Hermès-like margins. But essentially what Hermès has is a supply chain that makes beautiful products. Let's give them that. They are definitely artisans, but has done such a good job of being super disciplined around managing supply well below demand that they effectively have a cash spigot. And that is, if they needed another $500 million in EBITDA to meet earnings this year, it'd be super easy. They would just say, ship another 40,000 Birkin bags and ties and scarves to our distribution, and they will get absorbed immediately. And that ability to manage any projection they make, because literally an apocalypse could come, and I'm not sure demand would fall below supply. And analysts go, they're just going to hit their numbers because they have this tap of cash they can turn on at any moment. And as a result, you have a luxury company trading at 4 times what Nike is trading at on EV to enterprise, on an enterprise value to EBITDA margin. But this is a lesson in scarcity and how to manage a brand.
Yeah, it kind of reminds me what you and Aswath say about Apple and Tim Cook, which is like the thing that makes Apple so great isn't what they've done, it's what they haven't done. They could be releasing all of these products, all of these services, but they specifically choose not to, which is what inspires so much confidence in investors. And so from the perspective of Hermès, and maybe even Lululemon, which is sort of a tier one brand, I mean, it's not luxury necessarily, but it's high end. When a financial analyst is looking at these companies and they are modeling out that the value of this company, that we should be applying a higher value on that company's revenues versus another, is it that the brand is just really great to them and that makes them think that there are strong moats around that business? Or is it literally, do you think it's more of like a financial calculation of what you said, which is there's a lot of money here that they could make that they are choosing not to, and we need to factor that into our model?
The answer is yes. So the other kind of analog here is that the auto company that trades at the highest multiple on revenues is Ferrari, because demand far outstrips supply. Could they make more Ferraris? Yeah, they're owned by Fiat Chrysler that knows how to make a shit ton of cars. But instead they don't. They purposely choke supply. All Ferraris are sold out before they hit the showroom. And you have to buy a lot of Ferraris to guarantee access to a new model. And they purposely constrain supply. And so essentially what you have is total certainty around them hitting their numbers. And the wealthiest man in the world has built his wealth on scarcity. The wealthiest man in the world sells stuff that we don't need, but we want. And that's Bernard Arnault. And Hermès is cut from the same cloth, if you will.
And just pivoting back to Lululemon. So a couple of years ago, they acquired Mirror, which is this at-home fitness equipment company. You install it on a wall, and it's got some weights that you pull on, and you know it was sort of the Peloton, the tier 2 Peloton for a while. So they acquired that company for $500 million. They just said on this report that sales came in way lower than they expected, and they even said that they might stop producing Mirror hardware altogether. So it appears that this is another hyped up pandemic company that sort of got lost in this acquisition. Do you think this is the beginning of the end for at-home fitness, or is there a place for this sector?
Yeah, look, it didn't work. That's the bad news. The good news is it doesn't matter. I think they spent $500 million on it. This is a company with a much larger market cap. And to a certain extent, it reflects well on management. Management needs to take risks and do risky things. And you can't keep failing, but occasionally a foul ball means you're swinging hard. So it's a blip. It doesn't really matter. Connected fitness. There's one connected fitness company I would argue. It's Peloton. It's got unbelievable NPS. Mirror was sort of a Me Too product that never really, I think, inspired that much loyalty. Difficult to set up. Just sort of, I don't know, just a bad cousin off Broadway to Peloton. And even Peloton's having its troubles, right? The company I would invest in home fitness is a non-connected home fitness company called Rogue. They just make gym equipment and weights, and it's just got a great kind of testosterone-driven brand. I think that's the play there. But yeah, connected fitness.
What is I've never heard of Rogue. Why are you?
Rogue's a gym equipment.
Into that?
Rogue's a gym equipment company. It just has a great brand. They do a great job managing their brand. It's basically weights, dumbbells, fitness equipment, bench presses, kettlebells, things like that. They do a fantastic job, and they've built a brand in what is a fairly non-differentiated category. So they're able to get exceptional margins. That's a great company. That's a company. If I ran a private equity firm, I would try and buy. I think it's a fantastic brand. But anyways, connected fitness. There's Peloton and it's barely holding on. It'll probably get acquired once the stock goes up a little bit. But yeah, Mirror. There's some other stuff. I forget the other one that's going out of business. There's another one. Tonal. Yeah. They just haven't worked. They just didn't get there. They weren't easy to set up. Not that much utility. People want to be back in the gym. Rest in peace. So speaking, by the way, of the recession, or has anyone heard from the recession, U.S. retail sales surpassed $7 trillion for the first time in 2022. That's up $500 billion from 2021. Consumer spending increased almost 2%, 1.8% to be exact, month over month in January. That's the largest increase since March of 2021. And the NASDAQ 100 has entered a bull market, rising 20% from its December low. And the S&P 500 is up 5% year to date. So we have a bull market, consumer spending up, U.S. retail sales up. I mean, again, has anyone heard from the recession? It does feel like inflation is still a bigger threat than the recession. And also a decent strategy around investing or where you should go to work, that is investing your financial capital or your human capital, is to bet on the top 1%. All over the world, our governments have been weaponized by people with money, and they are able to implement a series of laws and policies that take wealth from the bottom 99% and crowd it into the top 1%. And also globalization, network effects lend themselves to the incumbents and people who are exceptionally talented who now have access to a global market. So the result is the top 1%, anything that caters to the top 1%, I don't care if it's Ferrari or Four Seasons or Gulfstream, which is General Dynamics, or Hermès, is killing it. If you're managing a company in the luxury space and you're not doing well, the CEO should be fired. That means it's a management issue.
Isn't this sort of the worst scenario, though? That, I mean, those statistics you mentioned would suggest that actually the economy is doing great, consumers are fine, there are no problems. But if you look at the headlines and general media coverage, you get this sort of panicky fear that the economy is in decline and that consumers are in trouble. At least that's my read on the general vibe. If that is even partially true, isn't this sort of the worst of both worlds, where you have these luxury companies on a total tear and then the rest of the economy is just kind of stagnant? I mean, isn't that something that we should get worried about?
Well, there's two issues here. One is a societal issue and one is an economic issue or a shareholder issue. A decent shareholder strategy is to invest in the 1%. Why? Because our society is going down the fucking tubes. I mean, effectively, and I think this is your point, American democracies used to be optimizing for the lower 99%. Now they're being optimized for the top 1%. When I was your age, Ed, and I moved to New York, I went to pretty much any bar and would be packed, and it was a ton of fun, and you could meet people, and we were sort of all commingling. Slowly but surely, the top 1% sequestered themselves for a better vibe, a more manicured, higher-end party scene called the Soho House, and then Zero Bond. And in London, it's all now members clubs. The whole world is being optimized for the top 1%. Are you rich? Don't worry, your kids will get into Brown. Are you rich? Don't worry, you'll get the best healthcare in the world. But it comes at a cost to the lower 99. And that's probably a bit of an exaggeration. It's probably more like the world's being optimized for the top 10%. That is iOS. And anything below that is paying a price. And that's not to say rich people aren't a good thing. You need billionaires. You need wealth creation at the top. But when you have this kind of crowding where 80% of all income gains go to the top 1%, that means the rest of the 99 got to split the 20. And typically what happens is this type of income inequality self-corrects. That's the good news. The bad news is that the mechanisms of self-correction are usually one of three things: war, famine, or revolution. And we're getting to that point. When just 3 people have as much wealth as the bottom half of America, at some point, the bottom half of America figures out a way to take their money away because it's the easiest way to double their income. And this has happened over and over and over in Central America. Some very wealthy families weaponize government, put in place a series of laws and regulations where they don't have to pay taxes, and their wealth grows so extremely. But the bottom 99% see their wages go flat or down. And so what do? Eventually, they show up, they elect a nationalist, and they show up, knock on the door of the 1% and say, get your shit and get out of here, we're going to kill you. And then they take the factory and they nationalize it, and the whole thing goes to shit. They realize nationalized industry usually doesn't work very well, and they privatize it, and they start the cycle over. We're about 7 innings into that. I mean, just look at just fly into LAX, and I immediately get in my Escalade and bomb to the Beverly Hills Hotel, and I live an amazing life. But God help me when I go to the Rose Cafe and Venice and have any sense of empathy for our citizens and see what looks like a festival where thousands of people are camping out, but it's not a festival. There's nothing festive about it. It's thousands of homeless people lining the streets of everywhere from the beach in Venice to Wilshire Boulevard, where I used to play basketball at Westwood Park. It's now a homeless encampment. So, income inequality, investing in the top 1% is a great investment strategy, but you're right. It indicates a real underlying sickness in Western democracies where we have decided to optimize for two cohorts, and this will get me in trouble. And New York is the head of that. New York is optimized for two people, rich guys and hot women in their 20s. And for everyone else, it's a soul-crushing experience. Welcome to America.
I mean, just coming back off of our last discussion, that we were sort of criticizing catastrophism. I mean,
am I the catastrophist?
Now you're the catastrophist. You said we're 7 innings in. At what point are you going to get are you going to get seriously worried about this? And let's just use like Hermès as a proxy. At what point is Hermès no longer a buy because the wealth will continue to accrue to the top 1% who will keep spending their money on Birkin bags? Like how far out do you think we are? How bad would it need to get in order to reach that point? Because my assumption is you don't think that this is happening tomorrow. You believe that this is just a signal that it could happen in the future and we need to be wary of it. So my question is, where are we in that cycle?
Well, you could argue, I said we were 7 innings into a 9-inning game. You could argue we're already in the 11th inning. We're in extra innings because I would argue that Donald Trump is evidence of this.
Yeah.
And that is the middle class goes sideways. They see via Instagram and via television and Succession and, from their friend whose kid went to work at Google and made millions of dollars everywhere, how wealthy everyone else is being shoved in their face. And meanwhile, the majority of America hasn't had a raise in 40 years. And they get angry. And when people get angry, they become very vulnerable to nationalist, fascist type of content, which is essentially the same thing over and over. Your economic problems, your economic stress, your anxiety is not your fault. It's the fault of the elite. It's the fault of academics. It's the fault of the current administration. And I'm going to change things, and I'm going to demonize these immigrants who are taking your jobs and the cultural elite who talk a big game but then soak you for all your good. I'm basically this kind of nationalist, not discouraging violence against your enemies, claiming only I can fix it. I mean, history really does repeat itself here. The reason that Hitler came to power was for two things. One, the Weimar Republic, exceptional inflation, and two, the Great Depression. People don't want to say, oh, it's cyclical, it's part of the market. They want to think, oh, it's someone else's fault. And when someone convinces them it is someone else's fault, we go down a very dark path. And I would argue that an individual who inspired a insurrection vis-a-vis a social media app and was calling for his vice president to be hanged, and our representatives were hiding in the rafters from a mob, we're kind of already there. We're kind of already at the 9th inning.
Let's go to Mia on the street.
Do you own any luxury brand items?
I do. Gucci, Yves Saint Laurent.
I have a pair of heels, but I don't wear them anywhere.
I used to have Yeezys before. I don't even know if you consider. I'm selling them now, so if anybody's interested.
Okay, so I have a YSL purse, but we go to Hawaii because Hawaii sells them for cheaper because they're competing with the Asian market.
Good tip.
Yeah, good tip.
Is there something that you have your eye on, like a especially luxurious product that you're hoping to purchase at some point in your life?
I've always wanted a Prada Clio bag.
I want to be able to buy a good watch at some point. A Ferrari, to be honest.
Say, would you spend like $30K on a purse, for instance?
Someday, yeah. If I love it, yeah. Why not?
Awesome. Yes, I see that in your future. And how do you feel about like a Birkin bag?
I love it. It's one of the dream.
I could not recognize one if I saw it.
I really hate purses, so I'm purse adverse.
If I were as rich as Drake, I'd probably be collecting them too.
Luxury product in general is a manifest symbol of class division that harms most of humanity.
It's also like false comfort to have things like that, and it's false luxury. It's not true luxury.
And what is true luxury then?
Love.
Sheesh, yeah, hell yeah. Rock on. That was sick.
I think that this is the economy where, people in our age group just struggle to afford houses. So maybe luxury items before that are not a great idea.
What does your luxury look like?
Being so rich, you could throw money off a yacht.
Why do you buy luxury purses? What do they mean to you?
Okay, so, it's about status, Yeah. So, like, you grow up seeing, like, all these, like, fancy things, and you're like, ooh, I want that, but it's all a meaningless void.
Ultimately, is all a meaningless void?
Yes.
Okay. Would you spend $30,000 on a purse?
Of course not. That can go towards your education, folks.
So true. Facts.
You don't really need all these things, because I was listening to this other podcast about happiness, and it's not about, like all the things you collect. It's about experiences and all of that. But it's like you question, why do you even want these things? Like this Pauline bag. Why do I want this? I don't know.
All right.
Want to know what my name is?
Yeah.
Wealth.
Is it?
It is. You want to see my ID?
Wow.
It's wealth.
Damn, that's crazy.
Well, you chose the perfect person to talk about luxury.
Sure did. All right. Thank you, Will.
Thanks, Mia. Let's take a look at the week ahead. We'll see job openings data from February and the unemployment rate from March. And this week also might be the calm before the earnings storm. First quarter earnings season kicks off next week, and it starts with the big banks. Scott, what is your prediction?
We referenced this before. I think Hindenburg, assuming that they weren't in this like for a 1 week trade, I think they lose money on Block. I think Block is trading higher in 30 days than it was the day before Hindenburg came in. So I think this is a bridge too far. I think they lose money here. This video was produced by Patrick Warren. Olivia Raining Hall is our art director. Sarah Shu is our animator. And George Cardi is our video editor. Thank you for watching this edition of Prof G Markets. Please like, subscribe, and tune in next week.